Welcome to the first lecture that we'll be having on Chapter 3 of our textbook. This chapter relates to hospitality business structures. In the paralegal program, we have a whole course just on this topic. So if you want to do a deeper dive, for example, let's say you're thinking about being an entrepreneur at some point, it would probably likely be a wise investment for you to consider taking LGLA 2311. It is an online course, and through that course you'll learn a lot more of the mechanics about how to establish the various business entities that are available and the pros and cons of each one. Obviously, we're just going to be able to touch on those topics today, but just know that there are other resources available for you at Collin to do a deeper dive into those issues. Okay, so in this particular chapter, we're going to talk about a variety of organizational structures and operational structures. In this first lecture, we're going to focus on the organizational structures that are available to a business in the hospitality industry. Eventually, in another lecture, we'll talk about agency relationships as well. So let's go ahead and get started. When we talk about organizational structure, we're talking about the type of entity that your business is going to function in. For example, is it going to be a partnership or a corporation or some other type of business entity? The choice of business entity may sound kind of boring and not very glamorous, but it can, in certain cases, be what causes your business to ultimately be successful or for your business to go belly up. And so it is definitely an important issue to consider before you start your business. And it's also a decision that you won't make just once. It's very likely that as your business grows and expands and becomes more profitable, that your business will go through a variety of iterations, a variety of structures, and a variety of circumstances that can impact the structure that you're going to want to have. So this isn't a once and you're done type of situation. So what are the things that are important to consider when you're trying to decide which particular business entity structure you want? Well, this issue isn't tremendously important, ease of formation and maintenance. Once your business is going, this becomes less and less important. But when you're just starting out and it's really just you running the business, these can be big issues, especially if you don't have access to legal professionals. You want something likely to be as easy as you can work with, that you don't have to remember a lot of due dates and a lot of things that have to be filed. That can make your life easy at the beginning. Many times when you're starting, you don't really know whether this thing is going to take off or not, and so you want to keep yourself lean and mean. If you have to spend $5,000 or $10,000 on an attorney from the get-go, that may not be the best decision for you to make. It might be better to spend that money on other aspects of the business. Of course, once you're successful and you're a going concern, then you may want to revisit some of those decisions that you made initially when you were focused on ease of formation and maintenance, and now that has become less of a driving factor, and then you'll want to consider other options. The next one varies in its level of importance at the beginning of a start of a business. Imagine that you are Bill Gates, wildly successful, very, very rich man, and you have decided that you want to open up a taqueria. You love the tacos, you have a passion for it, and you think your tacos are the best ever. So what you've decided to do is establish it as a solo or sole proprietorship. And so you establish this taco stand, and you call it Microsoft Tacos, we'll say. I'm not sure if that might be a copyright infringement, but we'll just call it a Microsoft Tacos. Maybe you also offer micro crunchy tacos sometimes too. Anyway, and the business is going great. You're getting a lot of good word of mouth in the community. People are liking your tacos. They're coming on a pretty regular basis. And you're in the restaurant pretty often, and so there's that kind of publicity that comes with a rather famous person being in the restaurant. It kind of gets some excitement going in the community. So you're very satisfied with how successful your taco business is going. And so you hire a few employees to manage the restaurant because you can't be there every day. After all, you're saving the world, right? And so you hire Bob. Bob is going to be one of your taco chefs, and he's also going to manage the wait staff and run the cash register and a few other things. You think really highly of Bob. He seems like a great guy, and he is a great guy, but you know what? Attention to detail is just not Bob's thing. And so it ends up that you, Bill Gates, work on Mondays, Wednesdays, and Fridays. Um, but Bob is going to be working on Tuesdays, Thursdays, Saturdays, and Sundays. When you, Bill Gates, are there, you're very meticulous. You make sure every I is dotted, every T is crossed. You make sure if there's been a snowstorm, you shovel the front stoop. If you are having a special taco offering, you make sure you have all of the ingredients prepared so that you will be able to meet demand. And of course, you follow all the rules about food safety. You're very, very careful about that, very meticulous about that. But on Tuesdays, Thursdays, Saturdays, and Sundays, Bob is there. And Bob, he sometimes forgets to put the ground meat in the refrigerator once he gets them out. And he sometimes forgets to cook the chicken all the way through. After all, there's a long line. People want their chicken tacos. As a result, several people have gotten pretty sick as a result of eating the Microsoft tacos. Some of them have even needed to be hospitalized as a result of it. They've had significant medical bills. They've had to take time off from work. They have some real damages as a result of it. Anyway, they've elected to sue Microsoft Tacos. Once they sue, they soon discover, though, that really Microsoft Tacos is a sole proprietorship. It is owned only by you, Bill Gates. And because it's a sole proprietorship, there's no limitations upon the liability of the owner. In this case, Bill Gates, you. Well, guess what? Bill Gates has, billions of dollars in assets. And so when you sue Microsoft Tacos, you're actually suing Bill Gates. And the jury will get to find out all kinds of good information about the net worth of Bill Gates. And so cases that might have had a value of, $3,000, $4,000, $5,000, maybe $10,000, are now significantly more valuable, at least in the minds of the plaintiff's attorney. So as a result, Bill is kind of being bled dry from these cases. Yes, he's making money in his taco business. Maybe he's even clearing $100,000 a year. But you don't have to have too many sick people in order for the costs of doing business, the liability exposure, to be greater than the profits that you're generating. And so you can see when you have significant assets, you're very concerned with minimizing your particular level of risk associated with it, because you have to think about what could go wrong with this business. I mean, there's certain businesses there's almost nothing that can go wrong. For example, let's say instead of you making tacos, you instead made hair bows for people to wear in their hairs, maybe a bow attached to a barrette or to a bobby pin type thing. Even if Bill Gates started that business, I mean, how much liability can there be? If the bow falls off the barrette, I mean, come on, it's a bow, it's a barrette. This isn't real money. It's hard to imagine anyone being injured as a result of a hair bow incident. So some businesses are just inherently not involving a lot of risk. And then there are certain owners who just don't have any assets, and so there's really no point in suing them. But when you are looking at the hospitality industry, for the most part, those businesses are going to have the real potential for liability. So if you have already in your life real assets, maybe you've been successful in another business, maybe you won the lottery, maybe you inherited a sum of money, hey, maybe you even married well and your husband or wife has significant assets. Under those circumstances, then the concern about liability issues can be a driving factor in the decision. A third issue that is also important is the issue of taxation. This is really important to virtually everyone. You're concerned about how much your business is going to cost you in terms of the taxes that you have to pay. What sliver is the state of Texas and the federal government going to take out of your business? And this does vary significantly from entity to entity. Certain entities have more favored tax treatment than other entities. Also, there's issues that vary from entity to entity depending upon the particular circumstances of the people involved in the business. So it's while there's some general rules that this entity is usually involving less tax risk than other entities, you really need a full look at the assets and the particular circumstance of the investors to know exactly what may be the best choice. Finally, of course, you're concerned about growing the business if you're, especially in the early stages. Initially, you may just be thinking about making your business profitable, but over time, you might be interested in establishing, for example, other taco stands or other restaurants or other bars or whatever your business is. And so how much that business can grow is going to be affected at least to some degree by the entity that you have chosen. Some entities are more growable than others. Now, of course, if you happen to be in an entity that's not very growable initially, but later on you decide, yes, I'm ready to grow. I now am at that point in my business development that I want to grow the business. You can always change entities. As we said before, this is not a one-time and done situation. You're going to want to be evaluating and reevaluating your entity selection throughout your ownership of the business. Related to this issue of how much your business can grow is the issue of how effective is this entity structure at assisting you in raising money for the business? Because after all, that's the primary way that your business grows. You need to raise money to get money for the business so that you can open new locations, so that you can expand your menu or expand your the scope of your business. And so if you're able to raise money, that usually means you're able to grow, and certain entities offer more opportunities for raising money. All good things must come to an end at some point, and that's one of the things that you'll want to think about, maybe not initially, but eventually. What is your exit strategy for this? Do you plan on selling the business? Do you plan on ending the business and liquidating the assets? What is your plan for how to end the business organization? And that can be a factor in how you choose the business structure as well. Okay, so we've talked about the idea of organizational structure. Now we're going to talk about operational structure. So organizational structure is the entity choice. Is it going to be a corporation or a partnership or whatever? Operational structure is focused obviously on operations, in other words, on management. How will the business actually run? Who does what in the structure? So we're not focusing anymore on whether it's a corporation or a partnership. We're focusing on, do the owners actually make the decisions, or have the owners hired somebody else to make the decision? Really, all of the entities allow there to be some separation between the owners and the management. Although some of the entities, it's a more common structure than others. So it's not that if you pick this particular business entity, you're locked into this operational structure. But certain business entity structures do work better with certain operational structures. So there is some connection between the two. So here are some of our structures, or actually all the structures that we're going to talk about today from an organizational standpoint. Before we dive too far, though, into the particulars, let's consider for a second that state law drives most of these issues. There are some federal law issues, but for the most part, we're going to be looking at state law. And so obviously, in this case, we're going to be looking at the laws of the state of Texas. There are, in many cases, some important differences between what one state might provide in terms of organizational structures versus another entity or another state might provide. We especially see differences with respect to LLCs and LLPs. Texas has generally a structure that is very pro-entrepreneurial. That's the orientation. And so you'll see that they are, generally speaking, a good choice for these two last options are good choices for Texas entrepreneurs. If you decide to either start your business in a different state or grow your business into a different state from Texas, these structures may not make as much sense in a different state. For example, they may not even exist, although for the most part these entities exist in most or the vast majority of states. But even if they exist, they may not be as desirable. So one thing that you ought to think about is you ought not think, I have selected for all time LLC, and that must be the best structure anywhere that I might choose to do my business. You'll always want to see what the LLC term means in the particular state in which you're developing your business, because it could be a very different animal. There's a good chart in the textbook, or maybe not chart, but the graph, or not, maybe not graph, but anyway, table, we'll say. That will give you some good information about the pros and cons, the various characteristics of these business entity structures. As you're preparing for quizzes and tests, I encourage you to look at those tools. That's going to be very, very helpful. A good way to approach those, in my experience, is to go ahead and cover up the information and see if you can write out that same information, not word for word, but the gist of the information yourself. And when you've reached the point that you're able to list all that information, then you're prepared to take the quiz or the test. And so that can kind of get you prepared for that finish line, so to speak. So we're going to talk about that first option here. Let me go back here. So we're going to start at the beginning of the list. As we're talking about these items, we're going to see that we move from most simple to most complex. Most simple to most complex. So kind of our this is our single most complicated entities right here in the middle. The way that these are organized in our textbook is a little bit quirky. Most people would put this entity right here up here with the other partnerships. Most people would put it right here. And most people would put this entity right here. And so most people would like to go from simplest to most complicated, so I guess they would also flip this. But our textbook organizes a different way, and really it doesn't matter. But if you want to think about it going from simplest to most complex, we'd start with here, sole proprietorship. Then we'd have general partnership, that's the second simplest. Then we have a limited partnership, that's the third. Then we have an LLP, that's the fourth. And then we have a limited liability company, that's the fifth. Then we have an SCorp, that's the sixth. And then we have a CCorp, which is the seventh. Those are just some ways of dividing it up. That's not the order that I'm going to do it, though. I'm going to follow the order in the textbook, just because you may want to be reading along as we're going through the information in the textbook. Okay, so let's go talk about that simplest format, the sole proprietorship. And you can hear in the name two aspects. The first is we have the word sole, which of course in English means the only or the single. And then we have the idea of proprietorship, which of course means owner. So we have a single owner. And that gives you an idea about how simple the structure is. It's a business organization in which one person owns and most commonly actually operates the business. Now, the fact that you have a sole proprietorship does not mean that you don't have employees. You don't have to have employees. You could be a sole proprietorship and you might be the only employee of the business. But you could, in theory, have hundreds or even thousands of workers within a sole proprietorship, although that would be quite unusual. But it wouldn't be unusual to have maybe one or two or three employees, especially as you're growing your business and you're considering what the next step ought to be. So a sole proprietorship is definitely an option. This is the default setting. This is what you will create as a business entity if you don't do anything else. If you just start doing business, then guess what you have? A sole proprietorship. So the two big characteristics of a sole proprietorship, in addition to it being super, super easy to create, is that because there really is no separation between the sole proprietor and his or her business, is that the profits from the business are taxed at the owner's own tax rate. In fact, you don't even file a separate income tax return. You just report that income or those profits on your individual tax return. So it's very, very transparent, very easy to do in terms of filing the tax returns. And this is generally speaking a very favorable tax treatment. This is typically called pass-through tax treatment. Let me just go ahead and write this up here. And we'll see that many of our entities have this pass-through tax treatment. And when we say pass through, what we mean is that the profit passes through the entity, the sole proprietorship, and is actually taxed for the first time when it lands in the owner's piggy bank, so to speak. So it passes through directly to the owner, then the owner pays the taxes on it. So this is generally an advantageous setup. There can be somewhat quirky situations in which this is not as advantageous as another option that we'll see later on, but probably 95% of the time this is the better tax treatment, what people are going to want to see. And not only does it have very advantageous tax treatment, but it also has a lot of ease. There aren't other paperwork to file. And so we see that with some of the entities, yes, you may have the pass-through tax treatment, but there may be some additional hoops you have to jump through in terms of filing your income tax returns. So this is both easy and frugal in terms of tax payments. Of course, the big downside is the sole proprietorship is that there is unlimited personal liability. You may recall when we were talking about Bill Gates' Microsoft tacos, he was at complete risk if Bob, his employee, made some tacos that made people sick. Bill had unlimited personal liability. Even though Bill didn't do anything himself, Bill was very careful about maintaining food safety, but Bob, his employee, his agent, wasn't so safe. And as a result, Bill could be successfully sued and could experience a significant financial hit. So Bill Gates does not want to establish a sole proprietorship. But let's be realistic. If you and I established a sole proprietorship, obviously just one of us would have to do it, it might not be such a terrible choice. Let's say that your net worth is $20,000. You put $10,000 into your business, you have $10,000 in your piggy bank. You're not a very desirable target for a lawsuit. No offense, but you really don't have enough money to interest a plaintiff's attorney for the most part. And as a result, you may not find that this risk of unlimited personal liability is really that great of an issue in your life. Now, of course, if you go out and win the lottery tomorrow, that calculus is going to change. Sole proprietorship also has another downside, which is it's relatively hard to grow the business. You need to figure out a way to raise funds, and one of the big ways that people raise funds is by bringing in new investors. Of course, as soon as you bring in a new investor, you're no longer a sole proprietorship. And so as a result, this may make sense as an initial business organization, but even if you can live with the unlimited personal liability, you're probably not going to be able to live with the sole proprietorship aspect if you're wanting to grow your business beyond the very small level. So let's go to our next term, general partnership. And as we were talking before, we were talking about how sole proprietorship was the simplest form of entity. Well, the second simplest form is a general proprietorship. A general partnership. Really, a general partnership is, for the most part, like a sole proprietorship, except instead of it being a sole proprietorship, you have more than one proprietor. You have at least two owners. Whenever you have a partnership, you need at least two or more. You can't have a single person entity partnership, because the name means partnership. You got to have at least two. You can have 2,000, but you have to have at least two. So there's no upper maximum limits to the number of partners that you can have. So let's assume that Bill Gates decides that he wants to bring Warren Buffett into his taco business. And so he and Warren Buffett When maybe Warren Buffett invests an extra $100,000 into the business and he takes over Bob's shift. And so now we have Warren and Bill owning this business together. They still haven't filed any paperwork with the state of Texas or wherever they have their taco stand. And as a result of their new structure, they have, in a wink of an eye, gone from having a sole proprietorship when Bill was the only owner to a general partnership. There are now 2 owners. And again, this is the default setting that we have when you have more than one owner and that the owners have not chosen to create any particular type of entity. This is what you have happen under those circumstances. And as I note down here, this entity, a general partnership, works just like a sole proprietorship, except that it has more than one owner. So we have the same advantages. It's super easy to form. Really, you don't have to do anything to form. It's the default setting again. You have the same concerns about unlimited personal liability as you did with the sole proprietorship, though. And in fact, I would argue that the concerns are even greater with the general partnership because, back when Bill Gates was running his taco stand, before he hired Bill, and so before he hired Bob, so it was Bill running the taco stand every day. You know what? If something bad happened to the taco stand, Bill was kind of logically on the hook for it. I mean, if Bill left the ground meat out, he kind of deserves to face the consequences of that. And that's the way sole proprietorships typically begin. The sole proprietor is kind of a Jack or Jane of all trades doing all the different functions. And so if he or she screws up, it kind of makes sense that he or she is on the hook. But once you get to a general partnership, you have at least 2 owners, and usually both people are involved in the business, although it doesn't have to be the case. And oftentimes you start finding that there are some employees as well. And so now Bill is on the hook for not just the bad decisions Bill makes, which kind of makes sense, he'd be on the hook for those, but also for the bad decisions Warren makes, and for the bad decisions the employee Bob makes, and for the bad decision the employee Sally makes, et cetera, et cetera, et cetera. Well, think about it. Bill may not have even hired Sally. Maybe Warren chose to hire Sally. And so Bill is now going to be on the hook for bad decisions that his partner made and the bad decisions that an employee has made. So there's actually increased risks as the business grows as a general partnership in terms of no limitations upon personal liability. From a tax perspective, it's very similar to sole proprietorship again. We have that pass-through taxation status. There's a little bit more complication because now we have some legal separation between the general partnership and Bill Gates and the general partnership and Warren Buffett. So it's not, the law doesn't treat them as exactly the same entity as we had when we were talking about the sole proprietorship and Bill Gates being essentially one and the same entity. But there is some separation there between a general partnership and the general partners. But in terms of at the end of the day, the way that the taxes are calculated, it's going to be the same amount. We're still going to have that pass-through taxation treatment. And we're going to find it a little bit easier with this structure to raise money simply because once Bill and Warren need to raise some more money, they can go talk to Mark Cuban or Carl Icahn or somebody else and bring in another partner into the business. And so the partnership structure allows the business to grow at a quicker rate because it allows the raising of money through the buying in of an ownership interest. Here we go. Let me go to the next slide. Okay, so now we're ready for a limited partnership. This is an entity that was wildly popular once upon a time. The reason why it's not so popular now is because since the time that the limited partnership was invented, entities that are even cooler and more awesome have developed. So this is interesting to some extent as an historical artifact, although there are still some limited partnerships and there are some situations in which businesses actually prefer limited partnerships to some of the other entities we're going to talk about. So let's explore exactly what a limited partnership is. Well, this is our entity, and I said that this is simpler than some of the other entities we talk about, but in a way it's actually more complicated because this is our only structure that we're going to talk about that has two classes of owners. All of our other structures will only talk about a single class of owners, although sometimes they do have multiple classes of owners, but we're not going to focus upon that aspect of it. But a limited partnership, by definition, has to have two classes. The first class is what we're going to call the general partner or managing partner. And this person is just like the partner in the general partnership we were just talking about. It's just like Bill Gates and Warren Buffett in the Microsoft taco stand that they were running. The general partner in a limited partnership has unlimited liability, just like we saw in the general partnership. He or she also has the ability to run the business, to make the big decisions. He's typically, or she's hands-on in that situation. So that's one class of partners. You can have lots of general partners within a limited partnership, but typically there aren't a lot. Typically that's a small class of individuals. So that's the first class that we have. We have to have that. The second class are the limited partners. And many times limited partners is another term for it, which you've probably heard, which is silent partners. These are the money people. So let's imagine that Bill and Warren, they're not quite so rich anymore. Their taco stand is kind of not prospering. But they see that Mark Cuban has a lot of extra money. And they say to Mark, hey, Mark, if you'll invest in our business, we'll make you a limited partner. And so you won't have any risk of liability other than the amount of money that you're investing in the business. Then when Mark says, well, that sounds desirable, plus I have some really great ideas for how you ought to run your taco stand. You know, I think you ought to start selling queso, or you ought to start selling burritos, or who knows what his ideas are. Well, that's when you say, oh, no, wait a second. If you become a limited partner, you're going to get that benefit of limitations on liability. The maximum amount of money that you can be sued for is 100% of your investment in this product. So if you invest $100,000, that's the maximum you can lose. The litigants, the people suing our limited partnership, can't get at your net worth. But the trade-off that this entity permits is that the reason the entity gives you this limitations on liability is that you can't be involved in the day-to-day management of the entity. So you have to be silent. It has to be the general partners who are deciding things like menu and marketing and who they're going to hire and who they're going to fire. You are just providing the funds. And so we have these two classes. The taxation works just like a general partnership. So again, it's that pass-through taxation status. Liability, again, varies. General partner has the liability we've seen with the general partnership, and then the limited partner has that limitations on liability. You can see that this mechanism can be effective in terms of raising money because you just bring in more of these limited partners, the people with the money. And so that can be a good way of raising money. This is our first entity that you have to jump through some hoops in order to create. You can't just wake up on Monday morning and say, okay, we're now going to call ourselves a limited partnership. With a sole proprietorship and with the general partnership, that was the default setting. You didn't have to do anything to create these entities, but that's not the case with a limited partnership. You have to do stuff. You have to file paperwork in a particular state to accomplish that goal. And we'll talk more about what that paperwork looks like in a few minutes. So now, well, here we have the definition of a limited partner. This is the entity in a limited partnership relationship who is liable only to the extent of his or her investment. If Mark Cuban puts down $100,000, that's the most he can lose. But again, limited partnerships have no right to manage the partnership. If they attempt to, if they start getting involved in the business, it's very likely they'll lose their status as limited partner and become a general partner, and they'll lose this limitation on their liability. So kind of a dangerous thing. You don't want to do that. And we already talked about a general partner. This is the entity. When we say entity, we mean the person. It could be a human being, or it could be a corporation or some other entity format. But anyway, we'll think about it when we're talking about Mark Cuban. Obviously, we're talking about a human being in a limited partnership relationship who makes the management decisions and can be held liable for all debts and legal claims against the business. So in our limited partnership, Microsoft Tacos, that would be Bill Gates, and Warren Buffett would be the general partners, and Mark Cuban would be the limited partner. Now we're up to corporations. The corporations is the most sophisticated of the formats we're going to talk about. When I was in law school, this was the main entity that I went to law school from 1987 to 1990. This was the main entity that anything other than really, really small businesses were in. So my business organization course was called Corporations. Now there are additional choices available that we'll be talking about in a few minutes. And so as a result, most law school classes are no longer called corporations, they're called business organizations or business entities or something along those lines. But the corporation is still the rock star in this area. This is still the entity that anything other than small businesses are going to ultimately land on it. You know, if you're Exxon or Walmart or Hilton or Marriott, you are going to be a corporation. And that is the go-to structure when you move beyond small business size. So what is a corporation? Well, it's a group of individuals granted a charter, and again, this is all driven by state law, so they're granted a state charter, legally recognizing them as a separate entity with rights and liabilities distinct from those of its members. So here we have a few things that we want to talk about. The first of all is that this is our first entity in which every single person associated with the entity has limitations on liability. Every single owner of the entity is only risking the amount of his investment. So let's now imagine that Microsoft Tacos becomes Microsoft Tacos Incorporated. And Bill Gates buys 100 shares, and Warren Buffett buys 200 shares, and Mark Cuban buys 300 shares. So there's a total of 600 shares out there. There's a catastrophic event that happens at Microsoft Tacos. You know, 1,000 people get really, really bad food poisoning, and they sue the business for, you know, bucket loads of money, and the business goes completely belly up. They don't have nearly enough assets to satisfy the judgments. But guess what? The total amount of exposure that Bill, Warren, and Mark have is however much they've invested. So if when Bill bought that 100 shares of Microsoft Tacos for, we'll say it was $300 a share, then 300 times 100 means that his total exposure is only $30,000, even though obviously he's a much wealthier person than that. So that limitations on liability applies to all of the shareholders, and that's a really, really important characteristic for a corporation. So that's the good thing about corporations, but there's a not so good thing about corporations, and that is the tax treatment. The tax treatment is usually called double taxation. And you can tell by the name, this not likely to be a good thing. Nobody wants to get taxed once, so you can imagine how thrilling it is to be taxed twice. And this is in contrast to the pass-through taxation. So what will happen is, let's say that Microsoft Tacos is wildly successful, wildly profitable, and let's say they've made, we'll say, $1 million in profit in a particular year. Well, if it's a corporation, Microsoft Tacos Incorporated, it's going to have to pay a corporate income tax. It itself is going to pay taxes on that $1 million in profit. Then it's very likely to issue a dividend to all the shareholders. So again, maybe it'll be a $1 per share dividend. So Bill Gates is going to get $100 because he owns 100 shares. Warren Buffett's going to get $200 because he owns 200 shares. And Mark Cuban is going to get $300 because he owns 300 shares. So once our owners get that money, they might look at it and go, well, gee whiz, I shouldn't have to pay taxes on this because it was already taxed. The corporation itself paid taxes on it. But unfortunately for the shareholders, that's not how the code actually looks at that. Bill will have to pay taxes based upon that increased revenue he got from the dividend. So that dividend payment is actually taxed twice, once when it's inside, quote unquote, the corporation, and once when it lands into the possession of the shareholder. And that's double taxation. As I said before, double taxation is almost always a worse tax treatment than pass-through taxation. And so this is a downside to a corporate tax structure. Of course, the big upside to corporations, in addition to limitations on liability, is that it's a really, really awesome way to raise money because you just sell more shares of the stock. It is, and stock shares are very movable in the economy in a way that some of our other entities just don't have that ability or liquidity to move assets freely within the economy the way that we see with corporations. So let's dive a little bit deeper into corporations. We have the idea of a share. The share is an ownership interest. It's a fractional portion of a company in which the owner of that portion has voting rights and rights to a respective fraction of the assets of the company. So going back to our example, our Microsoft Tacos Incorporated had 600 shares. Bill Gates owns 100 of those shares, so he owns 1/6 of the business. Each one of his shares gives him a right to vote. So he has 100 shares that he can vote in terms of establishing, say, who the board of directors are going to be for this company. But because Mark Cuban owns 300 shares, you can see how he's really the guy in control here, because Bill Gates and Warren Buffett together own as much as Mark Cuban does separately. And so the more shares you own, the greater the control that you have. And you can see here, this is a little bit different than we were talking about limited partnership, in that the shareholders do have some level of control. They can vote in managers that share their particular goals. For example, let's say some potential members of the board of directors are in favor of Microsoft Tacos growing very quickly. Another set are interested in a more conservative, careful approach. Well, if Mark Cuban is in favor of the rapid growth and Warren Buffett is in favor of the conservative approach, and Bill Gates forgets to vote his shares entirely, Mark Cuban is going to win because he's the one that owns 300 shares versus Warren Buffett's 200 shares. But usually in a corporation, the owners of the business are not involved in the day-to-day operations of the business. Now, it certainly, when you have a corporation that's just beginning, it certainly can be, and it's not unusual for it to be the case, that the owners are actually the people running the business. But of course, once you get to the perspective of, say, of an Exxon or a Walmart or something along those lines, most of the owners of those businesses are not involved in the day-to-day operation. So there's a transition. When you have a really small corporation, yes, most of the owners are involved. When you get to a really large corporation, the owners are primarily just investors at that point. Now we have dividend. We've already talked about a dividend. This is that profit that is proportioned based upon the number of shares that the owner has. So it's a portion of profits received by a shareholder, usually in relationship to his or her ownership interest of a corporation. The dividend gets taxed, and before it was released as a dividend, it was taxed as profits within the corporation. That's that double taxation situation. Now we're going to talk about S corporations, but well, let's talk about S corporations first. The S in S corporations refers to subchapter S of the IRS code. And this is the first time really that we've talked about a federal law with respect to corporate structure, because everything up until this point has been driven by state law. And in fact, corporate law is state law driven. But whether a corporation is a C Corp or an S Corp turns on federal law. So whether or not it's a corporation, we look to state law, but what type of corporation it's going to be that when you look at federal law. So when we see this subchapter S, or S corporation, we're looking at the IRS code. And what the IRS code permits is for smaller corporations to enjoy that pass-through taxation status that we found so desirable when we were talking about sole proprietorships and general partnerships and things like that. But these are limited to the smaller corporations. In order to form and to maintain an S corporation, in fact, you can't have more than 100 shareholders. And there's other limitations too, but that's the most important. So you can see that wouldn't really work for an Exxon or a Hilton or a Walmart, because you'd have too many owners. You have too many owners to stay under that 100 level. And of course, for those big entities, we wouldn't be looking at an S Corp, we'd be looking at a C Corp. And maybe I don't have a slide for C Corp. Let me just see here. Perhaps I don't. Okay, so what is a C Corp? Well, there's another section of the IRS code, subsection C, that talks about your standard corporation. And in that situation, there is no restriction on the number of shareholders that you can have. But this one does have that double taxation. So when I was talking here before about corporations generally, I was really talking about C corporations, because most corporations, or at least, well, corporations of economic note in the economy are going to be C corps. There's probably more S corps than C corps. I don't know that officially, but I wouldn't be surprised by that. But certainly the big movers and shakers in the corporate world are going to be almost exclusively the C corps. Okay, so now we're done with corporations, and again, it's embarrassing how little we actually covered about corporations. So I'm just kind of more or less introducing the concepts, not doing it all a deep dive whatsoever. So now we're going to talk about LLCs. And LLCs, I said before, corporations are the rock star of the business entity world, and I'm not going to take that back one little bit, but I will tell you that LLCs are the rock stars of startups. This is what, especially in Texas, is wildly popular with entrepreneurs. I would say that as a general proposition, if you are an entrepreneur just starting out, you're going to want an LLC. Probably there's an 80% chance that's going to be the right entity for you. It's a really, really good choice. And in fact, Texas started the LLC entity. So we are kind of a trailblazers in this area. Let's talk about what an LLC is. Well, the first thing you may notice about the name is that we have the word company. We haven't seen that before. We've seen proprietorship, we've seen partnership, we've seen corporation, but we haven't seen the word company before. And this is a new, even though the word company isn't new, this is a new idea, because a company isn't a partnership, it's not a sole proprietorship, and it's not a corporation. It's a new thing. And so let's look at the characteristics. It's a type of business organization that protects the owners from liability. So we have that lovely limitations on liability that we saw with corporations. But we don't have to jump through all of the hoops that corporate law provides. That's one thing we didn't really talk about before. So let me just remind you that while there's lots of advantages to corporations, limitations on liability, easier to raise money, there are two significant downsides. One is the double taxation, and then the other is there's a lot of formalities associated with it. There's a lot of paperwork that has to be filed, and if you miss a deadline or don't do things exactly right, then you are jeopardizing your business structure, and that's not a happy place to be. LLCs don't have a lot of these corporate formalities. There's relatively little that you have to do. You have to do some things because it's not the default choice, not the default entity structure, but it's much easier to maintain, much easier to create. Generally speaking, you have that pass-through taxation status that we talked about with respect to sole proprietorships and general partnerships. And so we're avoiding that double taxation situation. The textbook says that some states don't treat LLCs as pass-through entities. Texas does, though. So where it says some states do while other states don't, we're in the other states don't category. We do not tax the profits of LLCs directly, only when the owners are filing their income tax returns or the taxes levied. So we have that pass-through taxation status. An entity that's somewhat similar to an LLC is an LLP, and you can see it starts the same way: limited liability, limited liability. Technically, this is a partnership instead of a company, so it has some things in common with a general partnership and limited partnership. There's two probably big differences between an LLP and an LLC. The first is just a relatively small deal, which is when you have an LLC, you can have a single owner, and the owners are actually called members. So you can have a one-member LLC. But we already talked about when you're dealing with a partnership, you have to have at least two owners, or you don't have a partnership. So an LLP requires at least two owners, and that's a difference. The second difference is that most LLPs are focused on professional businesses. And when I say I don't mean that hospitality businesses aren't professional in the sense that they're not responsible and conscientious and smart and all that good stuff. But when we talk about the term profession in this context, what we're talking about are things such as accountants, doctors, lawyers, engineers, teachers, people who are in the kind of old-time meaning of the word profession. I'm not going to do a drill down and explain exactly what a profession is versus another type of business opportunity, but some states restrict LLPs to these professional entities. When LLPs were first created, everyone thought, well, this is what their niche is going to be, and certainly there's lots of law firms that are structured as LLP, but there are also lots of businesses that aren't professional entities who have chosen the LLP structure. So LLP structure is a really good structure. As long as you have at least two investors, you can definitely choose that instead of LLC. You'd again want to look to the ins and outs of your particular state. The LLP structure in Texas does have some fees associated with it that make it a little bit less desirable choice than the LLC in most people's minds. So this is definitely the one that I would say particularly a Texas entrepreneur is going to want to think about, especially if he or she isn't an accountant or a lawyer or an engineer or something along those lines. So we are going to end our discussion of organizational structures, and we're going to go to this Texas Secretary of State website. So what you do is you type in sos.state.texas.us, or you could just type in Texas Secretary of State. Of course, it'd be nice if I were a better typist, right? And it's going to be the first hit. So I've already done that. I'm just going to go to this page right here. And one of the neat things, and this is true for every state, but certainly Texas is good at this too, is this is the place, let me pause first. I'll think maybe you were like me before I went to law school. When I hear the term Secretary of State, I think U.S. Secretary of State. And, that person currently is Rex Tillerson. In the past, it has been John Kerry. Condoleezza, I don't know if Condoleezza Rice, but Madeleine Albright was Secretary of State. Hillary Clinton was Secretary of State. Those types of individuals, they weren't doing what Mr. Rolando Pablos does for the state of Texas by any means. They were negotiating ceasefires and international diplomacy and things like that. The Texas Secretary of State isn't involved in those issues at all. His role is establishing business entities. He's helping business in Texas make progress. And so what we're going to do on this website is we're going to go to business filings. And you can see nowadays all of these documents can be filed electronically. I'm going to go down here to within business filings, and go down to the third item, which is called Texas Business Law. Actually, I'm going to go farther than that. I'm going to go to Texas Startup Information. So I guess it's the sixth item down. I'm going to go to the first hit, which is selecting a business structure. And this gives you some overview about some business structures that you have. And you can see What do they spend the most time on? LLCs. What do they spend the second most time on? Corporations. So these are the big things. This is a nice summary about the law, especially as it exists in Texas. You can also find other places to kind of look. One goal that you may want to, or one place you may want to look is under guides and resources. I'm not going to click here, but this has additional places to look to gather some additional information. But now we're going to go to the business and nonprofit forms. This is where you can get some documents that will allow you to actually create these entities. Now, you're not going to see a form here for sole proprietorship or general partnership because those are the default setting. You don't have to file anything to create those. But if you want to create a for-profit corporation, you're going to need a file like this one. It doesn't have to be exactly like this one, but it has to include the information that we see in file 201. If you want to establish a limited liability company, you're going to have to do something like 205. If you want to establish a limited partnership, you're going to need to establish something like 207, et cetera, et cetera. I'm just going to pull up the certificate of formation for an LLC, and I'm going to pull it up as a Word document. Just so you have a sense as to what's involved in this. And you can see it's a really simple form to complete. There's some instructions to begin the form telling you exactly in each one of the fields that you're going to be typing what you want to consider. Let's just look at the form for a second. We can see we have the name of the form, Certificate of Formation, Limited Liability Company. Let's go back to our idea of having Microsoft Tacos. Now, after the name of our entity, we say what type of entity it is. And in this case, we're establishing a limited liability company, so we're probably going to put LLC after it. If we forget to put any letters after it, we haven't successfully created this entity. If we do this, we are actually saying that our entity is a corporation, but we filled out the wrong form because this is the form for a limited liability company. So our signal after the name has to match the entity that we're creating. And you can see the name, it says here, the name must include the words limited liability company, limited company, or an abbreviation of those phrases. And most commonly, you're going to see LLC. Sometimes people will put periods after it if you want to, whatever. But this would be the most common way of structuring it. Then you'll have to have a registered agent for your business, and then you'll have to pick whether you're going to have managers or not. This is something that we're going to talk about in our next section. You're going to talk about who the organizer is. In our example, the organizer was, I'm guessing his name is really William Gates. I think it's William Gates the Fourth, if I'm correct about that. And you'd provide his address. And then you establish, well, when does that document go into effect? Let's say it's going to go into effect immediately. And then you'd again have, you'd print his name here, William Gates the Fourth, and you'd have him sign it and you'd have it dated. So you can see the document takes very little time. I know we didn't talk about this here, but very little time to complete in order to establish your document. Now there are some fees associated with it. Let's see where we have that information. It's $300. Here we go. Payment. The filing fee for certificate of formation for an LLC is $300. So not going to break the bank in order to establish this. But establishing a sole proprietorship is $0. So if your money is tight, that might be a deal breaker. Once you're going and making money, that's when you switch over to an LLC. So this is an overview of how various business entities are created in Texas and the advantages and disadvantages of each style. I hope that this information has been helpful for you. We will obviously continue with this lecture going forward in subsequent recordings, but if you have any questions about the material that we've covered so far, Feel free to email me with those questions. Again, don't send it to the Canvas messaging app, but go ahead and send it to cgroover@collin.edu. Or perhaps even a better choice would be to stop by my office hours and we can talk at length about any questions or concerns that you might have. I do want to flag for you that if you are an entrepreneur and you're thinking about how to go about structuring your business, I can't give you individual advice. I'd love to, but my role in the course, of course, is not to be your attorney, but to be your teacher. So I'll be happy to refer you to an attorney who'd be able to assist you with giving you specialized advice in this area and or refer you to various publications that can help you in this area. Again, thank you for your attention and have a wonderful day.